For our last two sessions here on our day two of the 7th Annual Wealth and Asset Management Conference. Now, in our penultimate session, Rich Clarida, Managing Director and Global Economic Advisor. Rich is the Managing Director in the New York office and PIMCO's Global Economic Advisor. Prior to rejoining PIMCO in 2022, he was the firm's Global Strategic Advisor from 2006 to 2018. He served as the prior to that, he served as the Vice Chairman of the Board of Governors of the U.S. Federal Reserve System from September 18 to January 22. And Dr. Clarida is also the C. Lowell Harris Professor of Economics and International Affairs at Columbia University. Prior to joining PIMCO in 2006, he was the Assistant Secretary of the Treasury for Economic Policy, in which he served as Chief Economic Advisor to two U.S. Treasury Secretaries. Earlier in his career, he was the Credit Suisse and Grossman Asset Management. He's with Credit Suisse and Grossman Asset Management. He has 25 years of investment experience and holds a PhD and a master's degree in economics from Harvard. He also received his undergraduate degree with Bronze Tablet honors from the University of Illinois. Joined in conversation on his outlook for monetary policy will be Craig Fear, Principal and Investment Strategist with Edward Jones. Now, Craig is a leader of investment strategy for Edward Jones. He's responsible for analyzing and interpreting economic trends and market conditions, along with constructing investment strategies and asset allocation guidance designed to help investors reach their financial goals. He was named an Edward Jones Principal in 2015 and serves with the firm's Investment Policy Committee and is frequently featured in a variety of media and financial news outlets and is a regular guest host on Bloomberg TV. Rich, Craig, great to have you with us. Let me go ahead and turn it over to you.
Yeah, thanks, Ed. So Rich, let me maybe just first start with, on behalf of all of the folks that are joining us today, a sincere thank you. This couldn't be more timely in terms of an opportunity for us to maybe crawl inside your head, not only to learn a little bit about what you're seeing and thinking in your current role, but I know everybody's eager to hear a little bit about your assessment of what's going on now that you have an outside view of what's going on in the Fed. So certainly looking forward to the discussion. Appreciate your time today. Before we get there, and we're going to cover a lot of ground today, no doubt. Before we get there, I think it might be interesting and useful for everybody listening. And maybe if you could just share with us, you've had two stints now here at PIMCO. Maybe share with us what you do in your day-to-day role currently, and maybe how does that compare to your prior stint at PIMCO?
Well, first of all, I'm glad to be here on this event, and we do have a lot to cover, so I'll be brief. I'm thrilled to be back at PIMCO. My first tour of duty was 2006 to 2018, and then rejoined the firm in October of last year. There are really three parts to the job. One is that I oversee our secular forum process, which coincidentally actually commences on Sunday. It's a key part of PIMCO's investment process, goes back 42 years. And in each year, we carve out a week to set aside the day-to-day and month-to-month focus on the markets and try to step back and look ahead 3 to 5 years. We have in outside speakers, we have robust internal debate, and then the outcome of that process helps to inform the way that we invest for our clients. I'm also a member of the investment committee and advise the Global Investment Committee primarily on the economic outlook and on central banks. And then there's an important client-facing piece of my job as well, which I really enjoy. So it keeps me busy, but glad to be back.
That's great. So let me just draw in a little bit on continuing with your prior experience and your prior roles. So we'll dive a little more specifically into what we're seeing for monetary policy conditions, economic conditions. But before we do that, I'd be curious if you could share just a little bit with us. You've spent time at the Treasury, you spent time in academia, you spent time in the private sector, as you just discussed. Obviously, inside of that, you spent some important time playing a key role at the Fed. I'd be curious, outside of the policy for a second, what did you find most interesting? What impressed you most about the Fed as an institution and the role that you played? Was it the people? Was it the process? Anything that you would call out that maybe you were impressed by, or on the same vein, anything that you were surprised by as you joined the Fed?
Well, thank you, because the Fed's obviously an incredibly important institution in our system, but there's a fair amount of mystery around it. So I'm happy to give you my perspective. I'll talk a little bit about the surprises, and then talk about some of the other aspects. So before I joined the Fed in September of 2018, I had been a student of the Fed, if you will, as an academic who wrote scholarly papers on Fed monetary policy. And as a Fed watcher, I had the luxury of being able to focus pretty nearly on one thing the Fed does. And the Fed meets 8 times a year to raise or lower interest rates. And we had one of those meetings yesterday, or adjust its balance sheet, but traditional monetary policy. What I did not really appreciate till I got inside the building and inside the process is the very important role that the Fed plays in financial regulation and supervision, which I'm sure we'll come back to, as well as the important role that it plays in helping to sustain and support, if you will, the plumbing of the financial system, the repo markets, the money market, the treasury market. And so I had a lot to learn about both of those responsibilities. And moreover, what I discovered was that in order for me to think about monetary policy and to come up with a sense about a good monetary policy, I also needed to appreciate the interplay between monetary policy and the plumbing of the financial system, or monetary policy and regulatory and supervision. So I think that was the biggest surprise. In terms of the Fed as an institution, it was established by Congress in 1913. So the Fed is a creation of the Congress. In many countries, there is not a parliamentary or legislative foundation for the central bank. It oftentimes is essentially reports to the Treasury Finance Ministry. So the U.S. is different in that regard. People who work at the Fed tend to spend, especially the career staff, tend to spend their entire career there. They're excellent, dedicated public servants, good economists, good lawyers, and it was just an honor, privilege to be able to be their colleague for nearly 4 years.
I think we in the general public, we in the investment space, those that are responsible for advising clients on how to make smart investment decisions, appreciate, to your final point, the level of experience and skill and talent that resides within the Fed and that institution more broadly. So certainly appreciate that. Let's dive a little deeper. As you noted, the timing on this couldn't be better for all of us, given yesterday's announcement. No big bombshells, and we certainly, Rich, won't ask you to second guess some of your former colleagues' decisions, but would love to hear your perspective on a couple dimensions. I'll pull on a few of the threads that you raised. You noted the idea of you used to write scholarly papers on the Fed. Then you become a member of that institution, an influential member of that institution. Specifically, I'd be curious, as you think about the decisions that the Fed was making and announced yesterday, as you were inside those 4 walls, what's your view on the conditions that were most important? Obviously, we know the Fed's focused on inflation. We know the Fed's focused on employment. Financial conditions is kind of that third element. Where do you think the Fed's head was at? Where was your head at, even going into yesterday's meeting, in terms of the decision that was made?
Yeah, so I think an insightful way to describe it is for me to describe my thinking in late February, before the turbulence in banking emerged. So I was in the camp coming into the year that I took the Fed guidance and the chair at his word. So at the December meeting last year, remember, of course, last year we had the most aggressive rate hike cycle in 40 years. The funds rate went up basically 500 basis points in 9 FOMC meetings. And the last time that happened was under Volcker. And the Fed began to indicate towards the end of last year that at some point this year, it would begin to assess the cumulative impact of the rate hikes in place. That language changed in November. And then in December, in the quarterly projections, a strong majority of the committee projected that getting the funds rate to 5.25, at least 5.25, would be appropriate. The chair doubled down on that on February 1st when he said a couple more hikes would be likely, and that would include both the March and then the May hike that we got. But of course, a lot's happened since the end of February. We've had really, really disruptive turbulence in the banking system, really confined to banks in a category. You can't call them small community banks because they're 100 billion to 250 billion in assets, but they're not the mega financials that we're all familiar with. So there was SVB, Signature, First Republic, and then around the same time in Switzerland, Credit Suisse. And so there was a lot of eyes on the Fed in March, and other central banks, the ECB, Bank of England, Swiss, also had policy meetings around that time. And the Fed and the rest of those banks decided to go ahead with a rate hike. The Fed, of course, announced a new program the weekend that SVB went under, the Bond Term Funding Program, which essentially is a sort of a supercharged version of the discount window. But it's not a gift; it's a loan against collateral. And then obviously we have the situation with First Republic. I think a couple of things. I think that the Fed, and by their actions, other central banks do believe that they aspire to be in a situation in which they can separate their objectives, and they can use interest rates of the balance sheet to help achieve price stability and maximum employment, and they can use other what are called macroprudential tools to support financial stability. So I think they think that they can do that, at least through the March and the May meeting. The fact that they hiked rates and really now have rates up to the level that they thought would be sufficiently restrictive over time to reduce inflation. But obviously there are risks. I think the Fed's judgment is that the risks are to individual banks, not to the banking system as a whole. And I think I share that judgment. The banking system as a whole has lots of capital, lots of liquidity. And a lot of the fragility of some of these banks that have gotten into trouble is not so much that deposits are leaving the banking system, they're just going to other banks. And so this is a process that may continue. We may not have seen the end of it. But again, I think the banking system as a whole has lots of capital and liquidity and is profitable, but there's probably still some remaining adjustment. And I think the path that the FDIC and the Fed and the Treasury would like to see is they would like to see institutions that are getting into trouble essentially get acquired by stronger institutions. And that's what we saw in the context of First Republic. So I do think as well, however, that whatever one's view was of the appropriate level of the funds rate to deal with inflation, I do think now it's somewhat less. I do think the tightening and lending standards that we're going to see emerge from this episode is going to have an impact on slowing credit provision, especially to small and medium-sized companies. And so I do think that they'll go out of their way to refer to this as a pause, but my most likely scenario is that they're done. Now, they don't want to declare mission accomplished because mission is not accomplished. Inflation's too darn high, and they want to see it coming lower, but they think that the combination of what they've already done and what we're likely to see as tighter lending standards in banks will together slow the economy enough to reduce inflation.
It's great perspective. And you had made a reference to this prior about the idea that there is the official mandates of the Fed, and then there's this additional element of financial market stability, the plumbing of the banking and financial system that the Fed really does play a very important role in. And I think you just shared some great perspective on the thinking and the considerations that the Fed's facing at the moment, given some of these challenges that exist in the banking system. Do you feel like you talked about the bifurcated tools to address consumer prices, to address some of these financial system conditions? Do you feel like the Fed is at a point where it can manage both of those. And you alluded a little bit to this, but I think this is the central question for the financial markets at the moment, right? Which is that financial markets are saying policy has been sufficiently tightened. The lag effects haven't worked their way through. We've got a new problem. That new problem is this banking crisis.
Yeah.
And I got to imagine inside the walls of the Fed, it's a challenge for policymakers to think about multiple fires at the same time, one perhaps burning hotter than the other, or at least in the market's mind. Any sense on should the Fed be paying more attention to that banking crisis, or do you feel like the tools are calibrated at the appropriate spot at the moment?
I think they are paying attention. I think they're focused like a laser beam on it. As I said, I think the challenge that they face is different from the challenge that, for example, Bernanke and Geithner faced 15 years ago, because in that case, you really did have a situation in which, by plausible metrics, the banking system as a whole in the aggregate was in serious difficulty. So I think they believe, and I share with them, that it's not 2008. Unless we saw the rate hikes here and both yesterday and back in March. Similarly, look, the ECB hiked 50 basis points in March 25. The Swiss National Bank, which just a couple of days earlier, it had to basically wind down Credit Suisse hike. So I think that but I do acknowledge your point. These are two of the biggest bank failures in U.S. history, and there are other banks that may be similarly challenged. The other thing I would point out, Craig, is that in our system, for better or worse, there are really 3 and potentially 4 players involved when a bank gets into trouble. You always have the FDIC. But depending on if the bank is chartered at the state or national level, you can have either the Fed or the OCC, Office of Comptroller of the Currency, as its primary regulator. And then, of course, the Treasury Secretary traditionally drives the process in these sorts of discussions. And I think one of the things that we're all, including myself, recognizing, and the FDIC has been pretty forthcoming about this. Their chairman, Martin Gruenberg, gave a speech 3 years ago, actually, well before SVB, essentially highlighting that a potential fragility in our system is that we don't have a smooth way to resolve banks that are that they're not too big to fail, but they're too big to resolve in a weekend. Traditionally in the U.S., when smaller banks get into trouble, the FDIC has advance warning, and they discreetly start looking for a suitor. So people on Friday afternoon go home, and then on Monday they go back to their bank, and there's a different name, taped onto the door. But what we've seen here is obviously that did not work with Signature and SVB, and in effect, it really didn't work with First Republic. Yeah, they did wind it down over a weekend, but with a month of very publicized turmoil. So, that this will continue, I think, to be a challenge. And I do think because the overall system is sound, we will get on the other side of it. But I think that's another reason why we believe that the Fed is likely done here. Whereas if there had been no dislocation, for example, the chair testified on Capitol Hill Tuesday and Wednesday before the SVB failure, and sounded very hawkish. He actually was teeing up the idea that they could go 50 basis points at the March meeting. And so I do think that another reason to get the pause is they do think you're going to get tighter lending standards flowing from this.
That's great perspective. Let's talk about a little further about the knock-on effects of those tighter lending standards. I'll ask you the question that the entire market is dying to know the answer to. So we'll take you at your word here, which is recession or no recession. If we think about, as you noted, absent the bank crisis, if we were just thinking about the cumulative effect of all the policy tightening that's taken shape to this stage, there was an argument brewing that too much had been done, that by the time that filtered its way through the system, that tightening, that we were going to see some form of a recession. Now we add to this the tighter lending standards that only kind of serve to do more tightening in a de facto way. What are your thoughts, Rich, on the probability of recession, and maybe how the conditions that you just described are going to play a role in that, both monetary policy and the banking crisis?
Well, a couple of things on recession. If our baseline is that a recession is more likely than not, it's not a slam dunk, but most of the traditional indicators are definitely flashing red. We've had a very significantly inverted yield curve now for 9 or 10 months. The index of leading indicators is flashing recession. Tightening lending standards are usually a quite useful predictor that the economy is on the verge of a recession. We'll get the Fed's data on the loan officer survey on Monday. The chair gave sort of a hint in his press conference that indicated that it will probably show some pretty significant tightening. But it's also important to note that recessions are relatively rare occurrences. I think in the last 75 years, there have maybe been 14 of them or so, 12 or 14, depending on how you measure. And certainly no two recessions are the same. The last two recessions were in many ways the most challenging and most severe in the last 75 years. Obviously, in 2008, we had the global financial crisis and a recession around that time. And then in 2020, we did not have a very prolonged recession, but a very deep downturn when 22 million folks lost their jobs in a couple of months and GDP declined at a 30% annual rate. But those are really outliers. A typical recession, or certainly there are mild recessions that look much different. So, for example, in both 2001 and 1990, the U.S. was in a recession. But in both of those cases, GDP growth in the calendar year of the recession was actually slightly positive. And the rise in the unemployment was about 1.25%, 1.5%. So if we're back here a year from now looking back at 2023, and we see that in 2023, GDP growth was slightly positive, and the unemployment rate finished the year somewhere in the 4s, then I consider that a pretty darn soft landing, but technically that would probably be an MBER recession. So certainly before the bank dislocation, we were in the camp that any recession would likely be moderate and mild. We're obviously now we're focusing very closely on the incoming data to try to get an assessment of whether or not we need to have a substantial hit to the economy in the next downturn.
Yeah, it's great. It's great perspective because you're right. If you think back, and we've been in the camp for some time that, and this is not completely unique to us. I think you expressed something similar, which is that there is a case for a mild downturn, particularly because the consumer is in the shape that the consumer is in. So we've looked quite frequently at that 2001 period, where if you look just at household consumption, you'd barely notice that there was a downturn at all. I'm curious. We've talked a lot about financial conditions, banking crisis, about inflation. There is that other mandate in there for the Fed, right? Which is maximum employment, which is by all accounts is being met at this stage. What's your sense on just how much attention is being paid to that? Or is that kind of a given that the labor market is sufficiently strong that any lag effects that are going to show up are unlikely to cause a major spike in unemployment? Would you subscribe to that view?
A couple things here. I think that the Jay Powell has been, I think, commendably straightforward when he gets this question. He, in fact, at an earlier press conference, I forget exactly which one, he actually said that the rate of unemployment consistent with 2% inflation has maybe drifted up post-pandemic. Hopefully it will come back to where it was. I want to remind your viewers, so much has happened in the past 3 years, but if you just turn back the clock to January of 2020, the U.S. economy was in great shape. The unemployment was at 3.5%, so a 50-year low. Price inflation was just below 2%. Wage gains were 3.5 to 4. Productivity growth was picking up. There was absolutely nothing wrong with the January 2020 economy. There weren't the excesses that we had seen, for example, before the global financial crisis or before we saw the recession in the late 1980s or early 90s. And the challenge right now is that the unemployment rate is more or less back to where it was in January 2020. But the post-pandemic labor market, at least up to now, has changed in important ways. And now you have got wage gains of 5, 6, 7%. So I think the chair has said that at least for a while, the labor market is overheating, and a rise in the unemployment rate is not so much generating slack as it's just recognizing the very tight labor market that we're in. So at some point, maybe even later this year, when we start to see the labor market crack, the Fed will think it is facing that trade-off. But right now, to them, this doesn't look like a trade-off because they do think the unemployment rate is too low relative to the post-pandemic labor market. You know, Larry Summers and Olivier Blanchard, both of whom are friends of mine, and Olivier is a former professor, have written and weighed in on the notion that the Fed might not be able to see any decline in inflation until the unemployment rate got above 5%. The good news is it looks like that view is wrong. We've had a decline, I think, both in price and wage inflation, and so that's occurring with the unemployment rate at this level. But yeah, I think right now they don't view this as inconsistent with the dual mandate because they think the labor market is to some extent overheated.
That's great perspective. So you made reference earlier to the last two recessions. So we had the financial crisis in 2008, as you mentioned, the pandemic lockdown in 2020. As I think about your tenure at the Fed, I mean, name somebody else that's had more of the experience in different conditions than you, right? You came in to the Fed at the end of that phase of the tightening cycle from 15 to 18 and went through 19, recalibrating policy there.
Yeah.
Obviously, emergency response in 2020 to what was taking shape, which was unprecedented. And then the subsequent retightening of policy from there. I'd love to just get your thoughts and perspectives on that window in time. Obviously, the Fed was pulling out new tools in 2008 to address the financial crisis then, and those tools have stayed with us to a degree. I'd love to hear, Rich, your thoughts and perspectives on, as we were going into this phase that we were all enduring at the same time in 2020, as a monetary policymaker, how were you viewing that? An exogenous shock, a pandemic that has nothing to do with monetary policy and frankly can't be solved by it. How did you think about that? What were some of the tools that you guys were discussing, or that you in particular were thinking about and evaluating?
Well, yes, it was a cataclysmic shock to the global economy. It was a public health catastrophe. Millions of people around the world died, and since we all know how it turned out, it's I think easy and misleading to forget how little we knew and how serious the scenarios were. I'll give you one anecdote. Typically, I don't share internal anecdotes, at least involving other folks, but this has been reported in 2 recent books accurately, so I can share it with you. So in late February, the information we had, first of all, in late February, there were no confirmed cases of community transmission of COVID in the U.S. There were something like a dozen people who had COVID, but they had all contracted it on a cruise ship or a visit to China or something. And I did a CNBC interview with Steve Leisman the 3rd week of February, and he was asking me about the coronavirus. And the answer I gave him, which was my honest assessment at the time, was the coronavirus could impact the U.S. if China shut down. It would impact our imports and exports with China. Well, obviously the situation spiraled into a very dire direction just weeks later. So a week after that, the last week of February, Chair Powell called together a small group of advisors, myself, his chief of staff, and the senior career Fed economic staff, and basically said, all right, let's just talk about various scenarios. And they laid out some scenarios. And Jay Powell looked at me and said, so Rich, worst case scenario, is it the global financial crisis? And I said, no, Chair Powell, the worst case scenario is the Great Depression. And there was a pause in the room, but I wasn't exaggerating, because think about the following. How do you run a modern economy, a $20 trillion economy, in which you're shutting down economic activity by government fiat. And also people are just nervous about dying, and so they're not going out. So you're shutting down economic activity in a big chunk of the economy. How do you run a financial system where there are no revenues to pay workers, to pay the rent on your office space, to pay your bondholders or coupons, and we had to confront a reality that if we did not act, we could see the collapse of the U.S. financial system through no fault of any individual or company, because we were dealing with a public health catastrophe. So under the chair's leadership and with energetic support from his vice chair and other governors, we did go all in a period of weeks. We cut rates on March 3rd. We then cut rates all the way to zero on March 15th. We launched an ambitious QE program the week of March 16th. We rolled out and essentially relaunched programs that the Bernanke Fed had put in place to support market liquidity, money market, and the like. And then, and crucially, the next weekend, we deliberated and decided we'd have to do what we call break the glass, where you're doing something no Fed has ever done before. And we announced that we were going to directly support and backstop the U.S. corporate bond market and the municipal bond market. Now, importantly, both of these facilities were set up to be backstop facilities. The Fed never wanted to be the lender of first resort. And so anybody who borrowed from the Fed was going to have to pay a penalty rate relative to where the firm could borrow if markets were functioning. But we wanted them there in the eventuality that the corporate bond and the municipal bond market did not reopen. Now, in the event, the announcement effect was enormous. And just the announcement that we had a backstop facility, which with funding from the Congress to support the first loss piece of the facility that could have been close to $5 trillion in lending, was an enormous support, because then private corporate and municipal bond markets opened. In the event, Craig, we did not loan one penny to any U.S. corporation in the primary corporate bond market. In the municipal program, we did end up making two loans, one to my home state of Illinois, which is a wonderful place to grow up, but not known for fiscal probity, and then the Municipal Transit Authority, which here in New York runs the subways. But every other municipality was able to borrow and roll over its debt in the traditional capital markets. So yes, all's well that ends well. But I'm very proud of being on the group that just got that to happen, and have absolutely no apologies for going all in 2020.
So I'll speak on behalf of all of us in this call and the general public when I'll say that we appreciate that response, because as you noted, there is no manual for the decisions that you were making in that environment, but you described breaking the glass. And I think as we found in 2008 and then all the years afterwards, including the pandemic, where there were new tools that were behind that glass that were effective, while not in its exact same form, I think we continue in the markets to benefit from that, even as recent as the banking crisis, right? The ability for the Fed to have stood up the bank term lending facilities quickly. Wonderful examples of where breaking that glass yields benefits into the future. So we're appreciative of that. I suspect you also would appreciate, or perhaps not appreciate, the idea that the market also does a lot of second guessing on the Fed, which is probably not fair to policymakers, but nevertheless, it is the reality. And so as you think back, let's talk about as you're making those decisions, breaking glass in opaque conditions. One of the things now that's the lasting effect that the market has hemmed and hawed over is transitory inflation.
Yeah.
We don't have to rehash that word per se, but I would be curious, Rich, as you look back now, and we know what we know about inflation, and I think it's a little silly for any of us to have assumed that anybody, central bankers or not, had the extreme clarity of exactly what consumer prices do in a world where the globe is shut down for a period of time. But I'd be curious, your post-mortem assessment on where inflation went, how it got to that stage, and maybe just your view on where we go with inflation from here as we see conditions normalize to a degree.
Well, I will confess I was a charter member of Team Transitory, and perhaps it will surprise your viewers to hear me say that at the time that we put that in the FOMC statement, which I believe was March of 2021, we didn't talk about it a lot simply because at that point, in that same meeting, we released our forecast for inflation for 2021, in which our forecast showed that inflation by the end of the year would be running around 2.1%. So we really felt that all we were doing in the statement was just saying in words what our forecast was showing. I will also, since I also think it's important to note, this I guess is in the category of misery loves company, but seriously, certainly when I was at the Fed, and I think this other Feds do this, you really do when you're in that building want to guard against groupthink and getting caught inside the bubble. So I for one in particular, as the vice chair with primary responsibility to focus on economic and monetary developments, I was voracious in reading every outside forecast I could to see, is there something we're missing that the private sector is seeing, or that academic economists are seeing, or that the bond market is seeing through the break evens. And through about June of 2021, there was a collective view that the overshoot in inflation that we had seen in the first half of 2021 was not very broad-based. Indeed, I think at one point in the first half of 2021, 3/4 of the inflation relative to our 2% target was due to used cars prices. And I will tell you, and my colleagues were not prepared to throw people out of work because used car prices were going up. And I've got charts in a presentation that demonstrate all this, so I'm not making this stuff up. But it's also true that by the fall of 2021, all the measures of inflation that we look at showed that inflation was very broad-based and was accelerating. So if you will, imagine a hockey stick. So all the inflation charts that we were looking at, which were very well behaved through June or July, went hockey stick in the fall. So I've looked at this a lot. I've tried to assess what it is that we missed, what we got wrong, and I'll start with first and foremost what we got wrong. And what we got wrong was the post-pandemic potential aggregate supply of the U.S. economy, and I'll document that. So we began to see broad-based price inflation when the level of GDP was about 2 percentage points below our and the CBO's estimate of potential. We began to see broad-based wage inflation when the unemployment rate was 5%, whereas in merely 18 months before, the unemployment rate had been 3.5% with no wage pressure. Now, that's okay. You have periods when you have favorable supply shocks, and you have people with unfavorable supply shocks, but this was a big, unforeseen, unfavorable supply shock. Now, having gotten post-pandemic aggregate supply wrong, then the support provided by monetary and fiscal accommodation was inconsistent with our 2% price objective. We had a very accommodated, because I was still there, the Fed had a very accommodative policy in place, zero rates, a very, very, very accommodative QE program and forward guidance. And of course, there had been a lot of fiscal support. Indeed, between March of 2020 and March of 2021, there was north of $6 trillion in incremental fiscal support passed by Congress to deal with the COVID situation. So the policy mix was wrong. The policy calibration was not appropriate given the shortfall in aggregate supply. And I think it's pretty clear from the record that once the Fed recognized and diagnosed the problem, they pivoted to a tighter policy. What is true is, however, that as soon as the Fed noticed that inflation was broad-based, it did not immediately start raising rates, because the Fed had offered forward guidance to markets that it would only start to raise rates once it had stopped QE, and that it would follow would basically follow a tapering, and then it would end QE, and then it would raise rates. And that process ended up taking from September to March. And I'm sure future monetary historians and others will review that. But I think it's also important to remember that even if monetary policy counterfactually had been outsourced to a policy rule, a Taylor type rule, or a black box, that liftoff really would not have happened probably until the third quarter of 2021 as opposed to March of 2022. The other thing I would point out, which I think is important to remember because it often gets obscured in discussions about the Fed, is this is not just a U.S. phenomenon. In every advanced economy, save Switzerland, really, core inflation now is somewhere 3, 4, 5%, well above central bank targets. And all other central banks, save Switzerland, delayed the first hike until core measures of inflation were above target. So in my view, it was something about the nature and the magnitude of the shock and the complicated nature of the reopening and the recalibration of the policy mix that really across the advanced economies had a similar impact, which is that central banks after the fact were late in recognizing the problem and were slow to start hiking and have been playing catch up really ever since. So I hope that shed some light on it, but that's the way I think about it.
That's fantastic. And you made reference to used car prices. And I have long held the view that just as we look back on the tech bubble and Pets.com was the poster child, always should have seen it coming. And you look at the housing bubble in 06, 07, and you look at the lending standards and home price appreciation. Oh, it's obvious now. I will hold out used car prices, maybe along with NFTs, as the thing that you look back on, and it was clearly a sign of something. But I raised that point because I suspect it's interesting as a central banker, as you're evaluating this, you probably can't put a tremendous amount of weight on monetary policy conditions on abnormalities, right? You have to, I think, as I heard you say, you have to follow the data to a degree, and setting policy to worst case scenarios or exogenous outcomes is probably not fair.
Well, yeah. And I think, look, what I think that, and I've commented on this, I gave some remarks at a Hoover Institution conference a year ago. And so this is out in the public domain. I think that it's fair, not only in retrospect, but it's fair in real time to push back on the idea that central banks, perhaps out of necessity at first, had come to rely excessively on forward guidance. That is, instead of saying to markets, this is what we're going to do before we lift off, this is what we're going to do before we shrink the balance sheet, you basically say, guess what? We'll let you know at the next meeting. We raised rates today, we cut rates today, see you later. I'm old enough to remember Paul, that was more or less Paul Volcker. There were no press conferences for Paul Volcker. He wasn't going on the Today Show. He was up on Capitol Hill 4 days a year because that's mandated by statute, what we used to call the Humphrey Hawkins. Maybe gave a couple speeches a year, but that was it. And for a variety of reasons, in my academic career, I spent a lot of time on this. For a variety of reasons, central banks over the decades have become more reliant on offering forward guidance to markets and to the public about what they're doing. But as I pointed out at Hoover, like anything in economics, there is no free lunch. There are benefits and costs. The benefit of forward guidance is, especially if you're constrained at the zero bound and you can't cut rates deeply negative, then it helps to provide accommodation because you basically keep bond yields lower with dovish forward guidance. But there is a real case to be made that away from the zero bound, just abandon it and let folks know at every meeting what you're doing at that meeting. And so, in a world with zero forward guidance, counterfactually, you could have seen the Fed lifting off in September and, going as Jay did in June, 75 basis points to start that whole process. Instead of starting in June of 2022, you start in September of 2021. I will say that given the nature of the supply shock, which was enormous, and given the quantum of fiscal support, which was enormous squared, I cannot imagine a feasible or plausible path for the federal funds rate starting in June or September of 2021 that would have made roughly any difference to 2021 inflation. So wherever 21, I think PC inflation came in at 5.2. So, the Fed starts hiking in July or September. PC inflation for 2020 is still going to come in at 5.2. I mean, the earlier you start and the more aggressively you go, the more impact you can have on subsequent years. I get that. But the initial miss in 2021, I really don't think was something that even under perfect crystal ball monetary policy, given the supply shock and given the fiscal support, that you could have offset.
Just out of curiosity, because you mentioned the forward guidance, the communication mechanism, which has taken on a whole new life, maybe post financial crisis, post Ben Bernanke. Yeah. Is your sense that mechanism stays? We've seen this play out very interestingly this cycle, where the yield curve has become very kinked, and the market became, the 2-year gets really decoupled from the policy rate. Is your sense that level of open communication stays, or will there be a calibration again as we move forward?
Well, I think when it comes to forward guidance, and this is true not just for the Fed, but it's true for other central banks, there's a lot more talk among central bankers about getting rid of forward guidance than there actually is getting rid of forward guidance. I mean, for example, just yesterday, you would have imagined if there's any press conference where the Powell Fed maybe gets off the forward guidance bus, it would have been yesterday. And yet yesterday, Chair Powell was talking about, well, if you look at the SEP projections, or I think we're about done, we could be close to done. I mean, it's and it was especially interesting in the summer and fall when there was some commentary from some Fed officials that they were going to de-emphasize forward guidance. And then in the same speech or the same interview, and then they'd make reference to the SEP projections, which are graphs of forward guidance, the charts of guidance for rates. So yes, I always try to make clear when I get this question, we've had lots of examples of successful monetary policy over the decades that have zero reliance on forward guidance. So you can certainly do central banking very well without any forward guidance. I think you can make a case that at the zero bound, it is useful, but it's an open question about how valuable it is away. Now, what I would say is, as potentially costly as forward guidance was to the Fed in 2021, I think it was helpful to the Fed in 2022 because Powell did decide by that June meeting he wanted a very, very aggressive Volcker-esque liftoff, and he wanted to tighten financial conditions very quickly, and he was able to do that by guiding folks to future rate hikes. So again, I think it's a complex issue, but it's certainly one that critics of the Fed, can point to in their favor.
That's great, Rich. You've been gracious with your time and certainly with your perspective. Let me let you get out of here with a lightning round, if I may. If I might be so bold as to offer up a lightning round to a former central banker. Yeah. So here we go. Just a couple questions for you. First one. What are you most proud of in your time at the Fed?
Well, Craig, I'm proud of the fact that in 2018 and 2019, we had an economy with a 50-year low in unemployment and price inflation at 2%. We had models and we had academics telling us that if we didn't raise rates, inflation was going to surge, and we didn't see any inflation, and we were willing to let the labor market blossom. Then until people got a job, got a raise. And I'm proud of the fact that we adjusted policy in 2019. And really, let me say this, had it not been for the pandemic and had it not been for that shock, we would have helped the U.S. economy to engineer a soft landing, which is difficult to do. So I'm very proud of that.
That's great. This is the lightning round. Otherwise, we dive deeply into that. Because
I'll respect it. Yeah, okay.
All forgotten about. Okay, second one. What do you miss most about your time as vice chair?
Well, the first 2 years I was at the Fed, we were in traditional monetary policy where we came into the office every day. The Powell Fed was a very congenial place. There's a long hallway where all the governors have their offices. It was more or less an open door policy. I had high regard and respect and affection for my colleagues. And so I miss the interpersonal day-to-day of being a Fed official. And of course, my last 2 years at the Fed roughly was all work from home monetary policy. And so I am sort of sentimental about those quaint days when people came into the office 5 days a week to do monetary policy.
Walk down memory lane. Okay, so we spent a lot of time getting your perspective on your time in the Fed. I think rightfully so. We're all better off for it. You did spend some time at that other tiny little institution, the Treasury. You had to do it all over again. And this is maybe like making you pick amongst your children. But if you had to do it all over again, Treasury or Fed?
Fed.
I love the conviction. All right, I'm gonna give you two more, and these are the really important ones, Rich.
Yeah.
So this is what we'll grade you on. You're a Jets fan. How you feeling? You got your guy this year. How the Jets gonna do?
Remember the Brett Favre Jets were 8-3 before he hurt his shoulder. So I would take 8-3 at that point. I think we can get into the playoffs. Yeah, because the Jets had a great team last year in terms of young players. They just didn't have a quarterback. Or anyway, yeah. Okay.
What do they say? Past performance, no indicator of future performance. But past quarterbacks serve you well.
Unlike investing, I'll say this. I looked at Brett Favre, I looked at Aaron Rodgers' statistics. If you take his worst season at a quarterback, it's better than the best season of any Jet quarterback in 20 years. So I'll take Aaron's worst season next year.
If we could bottle up even a small amount of Jets fans' optimism and inject that into the financial markets, we'd be in great shape. All right, last one. You mentioned mentioned Metro Transit before. In your time on transit, I think you probably take the train up to Connecticut every so often. What are you listening to? What are you reading on that train?
I'm listening to two things. First of all, I do work on the train in the morning and a lot of evenings because I have a lot of reading to do. If I'm listening, The Economist has The Economist magazine. You can listen to the whole thing. Podcast, very convenient. And in terms of listening to music, I am an amateur musician and record. And so when I am listening to music, I listen to mixes of my own songs, not for enjoyment, but to improve and critique them. So
you are a man of many talents, Rich. We're all better off for having you spend some time with us. We certainly appreciate it. Ed, I don't know if I'm throwing it back to you, but Rich, it was a true pleasure to be able to spend some time with you. Thank you so much.
And next time we'll do it in person.
Look forward to it.
Okay.
Absolutely. Craig, Rich, thank you so much for your time today. Jets fans and optimism, that's kind of a new one for me. So I think we learned a lot during this conversation, but I do think there's a lot to be hopeful throughout everything we talked to today. So thank you again, Rich and Craig, for your contributions today.